We recently published a look back at sustainable finance issuance trends in the first half of 2023, with 3 key themes that may provide an indication of trends for the rest of 2023 and beyond. Those 3 are resilience, evolution, and progress. Global US dollar green, social, sustainability, and sustainability-linked bond sales from governments and corporates up to the 30th of June 2023 totaled around US $155 billion globally, and that was down around 4% from the same period last year per Bloomberg. Despite the year-on-year fall in total global GSSSL bond issuance, the overall sustainability finance market was actually resilient when compared to year-on-year issuance volume reductions in other global bond markets, including Singapore, where the market was down 19% year-on-year, and the Asia ex-Japan G3 credit market, which was down 35%. Similarly, US corporate credit and European credit markets were down around 25% and 15% respectively. We covered the reasons why issuance volumes were down in the first half of 2023 in our Singapore Credit Outlook for the second half of 2023 published on 30th of June. And those influences included interest rate hikes, inflation, and geopolitical tensions against the spectre of slowing economies. And that was mixed with event-driven crises, including a regional banking crisis in the US and the acquisition of Credit Suisse by UBS. The sustainable finance credit market was not entirely immune to these trends. 2022 was the first year-on-year fall in GSSSL annual bond issuance on record, but considering the market environment, overall performance for the sustainability finance market has been fairly resilient for 2 key reasons. The first was improved clarity surrounding regulations at the industry level and better information and clearer sustainability strategies at the company level. This drove global issuance of green bonds to record levels in the first half of 2023 per Bloomberg data. Green bond sales across all currencies reached a record US $169.4 billion in the second quarter, surpassing the previous record that was in the first quarter. The previous record before that was in the last 3 months of 2021, when around US $143 billion was issued per Bloomberg. The second reason was the change in issuer composition, with a rise in sovereign issuers looking to raise sustainability finance instruments to meet increasingly urgent and well-publicized climate goals in order to build economic resilience. According to a study published in the Management Science Journal on the economic impact of climate change on sovereign credit ratings, rising carbon emissions have the potential to lower sovereign credit ratings and thereby increase debt servicing costs for 59 countries in the next 10 years. Other impacts of rising carbon emissions include reduced economic output from extreme weather events. So what's an example of climate goals? One is the nationally determined contributions, or NDCs, that are each country's self-defined national climate pledges under the Paris Agreement. This covers an action plan to limit global warming to 1.5 degrees Celsius, adaptation plans to climate impacts, and ensures sufficient financing for the first 2 efforts. It is also worth noting that sovereign issuers are less impacted by the issuance conditions that prevailed in 2023. These conditions of higher rates and the regional banking crisis, for example, influence corporate issuers more. As such, sovereign issuers had the capacity and willingness to issue sustainable finance instruments in the first half of 2023. These reasons or positive drivers offset a few negative influences on the sustainable finance credit market in our view. These included rising concern on greenwashing and the actual sustainability impact of certain GSSSL bond types. This came hand in hand with more awareness and understanding of the sustainability finance space. Another influence was the recognition that the so-called greenium had diminished. According to data from the Association for Financial Markets in Europe that was reported by the Economist Intelligence Unit, greenium levels fell to around 2 basis points in July of 2022 from more than 9 basis points in 2020 per latest data. Greeniums are likely a necessary incentive to issue GSSSL instruments given the higher issuing costs related to providing external audits, second-party opinions, and additional documentation and disclosures, including a sustainable finance framework and project due diligence for these instruments. There is also the legal and political risks associated with certain sustainability finance instruments, such as sustainability-linked bonds. This subtype saw a large drop in issuance in 2022, as did social bonds given the lower influence of the pandemic and related social considerations, as well as rising concerns on the quantifiable and visible impacts of climate change. Social causes or impact, on the other hand, can be somewhat hard to quantify. The overall outlook for sustainable finance and GSSSL issuance looks constructive. Global central banks appear closer to the end of their rate hike cycles, which will help general demand for fixed income. On the sustainability front, the incentives for sovereign issuers to issue GSSSL instruments will remain high and will likely increase depending on the success of their net zero strategies. For corporate issuers and investors, the necessity and willingness to be sustainable from an operational, financing or investment and reputational angle will also continue to rise as information, actions and strategies continue to be refined to increase the impact of sustainability-focused activities, which are becoming increasingly mainstream. As the GSSSL market further develops, there may be more defined trends and diversification in the future. This could include higher issuance from emerging market sovereigns that are more exposed to the economic impact of climate change, as well as issuance from high-emitting industries, including airlines, that must balance their operating efficiency with the cost of transitioning to a greener future.